So guys, the Feds cut the interest rates today by 0.25%, right? And somehow in the mortgage industry, the rates stayed the same or even went a little bit slightly higher. Why? Because the mortgage rates, they don't abide by the Federal Reserve's rate cuts. They abide by the 10-year Treasury bond. And what happened and why so? Because basically the 10-year Treasury bond, the number one importance for them, it is the inflation. They want to make sure that if they're going to lock their money for 10 years, they want to make sure that their profit, it will outpace the inflation. So right now the inflation is kind of like being stubborn and it's not moving downwards, right? It's staying the same. Now, but you may say like, why the mortgage rates had to do with the treasury bond? It has to do because basically an average American family, within 10 years, whether they're going to sell their home or they're going to refinance. So like it's a really small percentage that keeps the loan for the end of its life. So that's why they're pacing the mortgage rates with a 10-year Treasury bond. And they want to make sure that they have a spread of approximately 2 to 3% profit. Basically, when it comes, like if the Treasury bond right now is at 4.1%, they want to make sure that have a minimum 2% profit on it, right? On the other hand, the Federal Reserve rates, basically it helps the credit cards. It helps basically the fast money, the money basically that doesn't have like it's not a long term, and it helps a lot the banks basically when at 4 p.m. when they want to balance their shit, they have to borrow money from one the other. So these are the difference. So if you want to focus when it comes to the mortgage rate, you want to focus to the 10-year Treasury bond. That's where we know if the mortgage rate is going up or it's going down. Have a great day.